How are you doing? This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options training academy. Got a really, really special show for you today. You know, I normally don't do a Friday show. Everybody that can hear me, let me know what part of the country that you're coming out of. And we're going to talk about the broad market perspective and has a stock market found about it. And this is going to be a really good show for traders, people that are interested in trying to figure out how to be successful in the market. And they often have a debate on whether or not they should just look at things from a fundamental standpoint or from a technical standpoint, or maybe combine the two. And the reason why I wanted to bring on Lance is because she's very skilled in understanding price action, technical analysis, but she also kind of understands how to mix the fundamental into it. And she can find things in the market that the average person may not be able to locate. And that's one of the things that allows her to have a great degree of success and also communicate those particular skill sets and those particular perspectives to the market. And so what Lance is going to kind of do, she's going to drive the car with this particular broadcast. And she's going to kind of break down what we see going on in the overall macroeconomic standpoint, what we see going on over in the equities market. We're also going to go into the VIX. We may go into some bonds. There's no telling which direction we're going to go into. But the goal of this show is for you to be able to watch it, use it as a resource, and to get a good understanding of how you can kind of look at the market to put yourself in the best position to be successful. So what I want you to do is not watch the show once or twice, but kind of use the show as a resource, keep going back through it, because I believe that every time you go through this particular show, there's going to be elements you're going to be able to pick out that's going to allow you to become more and more successful over time. And so that's something I really want to encourage you to do. So Lance, how you doing today?
Pretty good, David. Glad to be, talking with you again. I definitely appreciate it. And I definitely, the reason I'm so excited about this is because I thoroughly enjoy your take on the market. Of course, I'm a regular watcher of your content, always trying to learn things, and your perspective is unlike pretty much anybody else that I watch. So I definitely like that, and I definitely grateful to be here. So.
All right, I appreciate the compliment. I'm really glad to have you because I got a lot of respect for your ability to really understand technical analysis, price action. A lot of things that I implement, I got from you. That's one of the reasons why I included you in the VIP, because I knew that people could get a lot of value from your perspective of the market. And I think that, your ability to kind of cut through the fat and get kind of directly to what is actually going on can be beneficial to a lot of people that are kind of trying to figure out this trading space. So right. Go ahead and start rolling out kind of what you want to kind of talk about and kind of let me know what I can add in and kind of help you communicate that to the audience.
Okay, cool. So first off, I just want to start off with a question to the audience and ask you guys if the VIX's volatility is high or low in your opinion. Is it high or is it low?
Okay. I'm sorry, go ahead.
No, I was just going to say, and the answer to that can reveal possibilities, moving forward, and we'll definitely move into that shortly.
Okay. And so everybody, the question we're asking is that, do you believe that the VIX, that IV is high or low currently? And kind of give us some feedback based on, what you kind of believe about the VIX. And that's going to kind of allow us to kind of understand where we kind of want to take the show. So I know there's going to be a lag on it. And so just really quickly give us a basic answer of where you think that VIX IV is high or low, because there's been a lot of volatility in the market. So SB says high. So that's a good answer. There's been a lot of volatility in the market, and that VIX has been kind of moving around. I know you had talked about on one of your videos, you maybe thought it was going to go to maybe, I think, the low 40s.
Yeah.
So I'm still kind of looking for that. I was looking at some stuff. I did a technical analysis video today for my Discord, kind of where I think it's going to go. But it's been interesting where it's been at. So where do we think the VIX is at to the audience? So just give us a really quick answer. Do you think the VIX is high or low? You don't have to really spend a lot of time thinking about it. Just let us know. High. Miss Lady L says, especially this past month. Each cent says currently is high. Inflation, interest rates, gas prices, etc. contribute to this. So we got 18 people on the live stream. Just really quickly, let us kind of know where you think the VIX is at. And that'll kind of give us some feedback on your perception of the market. And I really appreciate the contribution from everybody that's on the live stream.
For sure.
Yeah. I did a video on telling options traders to kind of watch that VIX before they buy their contracts, because a lot of times people buy in a high VIX environment.
Yeah.
They get that premium. and then the VIX starts to slow down, and they wonder how come their premiums flattened out, even though they might have got the direction to move that they wanted. That happened to me a few times.
Mm-hmm. Yep.
Russ,
Same here.
I
Same
feel
here.
you. So it says it's way over its yearly average. Melinda Suzanne says it's high. Okay. All right, Lindsay, did you want to follow through with anything on that?
Yep. So actually, VIX's implied volatility is low. So that that just tells you guys with our perception of volatility versus the actual raw data is different. And don't get me wrong, you know, the markets have been, you know, crazy, with VIX being in that low 30s to high 20s for the last, you know, few months or so. But when you look at its actual implied volatility and analyze it, it's on the low end of its range. And how do you know whether implied volatility is high or low? Is you use something called IV rank or IV percentile.
Okay.
So that number allows you to determine whether the implied volatility for whatever, any ticker that you're looking at, is high or low. So keep in mind that VIX is more so broad market S&P 500, but every ticker has its own implied volatility that's going to be totally separate from what VIX is. So even VIX itself has its own implied volatility. So just so we don't mix up the two, when I say VIX is implied volatility, I'm not necessarily talking about where it's priced at. I'm talking about the actual implied volatility. So right now, I looked this up a little bit before the call. VIX's implied IV rank is at 22%. And the implied volatility, I think today closed at like 114%. And what that means is when the implied volatility rank is 22%, that means that 78% of the time, VIX's implied volatility is higher than 114%. So that lets you know that it's on the low side right now. And I'm going to show you guys how I analyze implied volatility. So for whatever company that I'm watching, whether it be on my core list of tickers that I trade or something that I'm considering for the future, I pull up like a daily chart over the course of like a year, maybe two, and then I put on the implied volatility indicator. And all I do is I just mark the high and low end of that range. And really, that's where you can look, especially if you like to swing or you like to buy leaps and stuff like that. That could be a good way or a good tool to use to know, okay, this is pretty much where the low, where premiums are going to be low for this ticker versus me buying and not even realizing that I'm buying at the higher end of that ticker's implied volatility, like VIX. Matter of fact, I'll just go ahead and pull up. I'll pull up VIX and show you guys right now.
Okay.
Can you see my Thinkorswim?
Yeah, let me go ahead and add it. Okay, you're good to go.
Okay. All right. So VIX, and I just have it's saved as a study, but implied volatility is the indicator. And like I said, I pull up a 1 year chart, at least, or a daily chart over a course of 1 year, and I look at where I look at pretty much support and resistance on the implied volatility itself.
Okay.
I'm not sure if Thinkorswim has an IV rank indicator, but what I do is I go into the Thinkorswim app under the options tab, and it has the IV rank right beside the implied volatility itself.
Okay.
So what you can see right here is that VIX tends to bounce when it gets down inside about 100 to 110%. So I mark that level there. And then for the most part, it tends to pivot most of the time, probably around like this 130% area, the low to mid 130s. And so I marked that area too. So basically, I can use this to know when prices are going to be high and when they're going to be low. If we pull up SPX, same thing. SPX tends to bounce when its implied volatility gets down to 18%. And then most of the time, it tends to pivot once it starts to get up to the high to probably to the mid to high 20s area.
Okay.
You can see, of course, that here lately its implied volatility has been high, and we can look at this data and tell that this is more of an outlier, right? So if I were like in a situation where I was like jumping in some puts down here, then I probably wouldn't chance it just watching VIX. I probably wouldn't chance it VIX going over, 25 to 30%. And so when it comes to, I'm just going to pull up a random ticker. When it comes to other tickers, the difference with implied volatility on individual tickers is that when the implied volatility on that ticker is low, you're going to get lower prices, and the prices on your options contracts are going to increase as that implied volatility rises. So it's not a whole lot of that inverse relationship that you see with VIX and SPX in general. A lot of times they have the positive correlation when you're looking at implied volatility on individual tickers. So I stress not to only rely on VIX, but also look at the implied volatility for your tickers as well. So if you're watching, you're like, okay, I think I want to get in a swing on this one. Go and do an implied volatility analysis and see if the prices are high or low, because of course you don't want to buy it at the highest possible price. It's just your chances of winning are pretty slim at that point. So just having the patience to just wait for that implied volatility to come down, I think will pay off in the long run. So that's all I wanted to say about implied volatility, unless somebody has any questions about that specifically.
Okay, so if you have any questions, put them in the comment. But I have some questions.
Go ahead. Okay.
When I'm looking at a ticker, the way you're doing the Thinkorswim, I'm looking at the implied volatility of that ticker. Is that going to be same as the IV on the options chain?
No, because the implied volatility on the options chain is going to be different at each expiration. You'll see. So this one is just based on that underlying stock. Okay.
So I should be in this scenario saying, okay, if the implied volatility on this, let's say we're talking about Apple, if that IV is high in my perspective, then I should look for a positive correlation to the options contracts also being high.
I would think so. Yeah.
Okay. Yeah, because that's something I try to tell people is that when you're looking at the IV on the options chain, I think somebody told me that the IV on the Affirm contracts yesterday was like 500%. So crazy. When you're looking at that, if you buy them really, really high, and like we say, you get that IV crush, it also happens right before you go into earnings. Even if you get the movement that you want, you're overpaying for the contract. So then when you get the premium crush, you're going to lose money on the contract, even if you get the direction that you desire. And I think that's what a lot of people, and maybe sometimes until they maybe experience that, they don't really understand the reality of it. That's how it happened for me. When I first started trading options, I'll never forget, it was I did an earnings play on Baba, and this was probably back in 2017, 2016, somewhere around in there. And I was right in the direction, but as soon as the markets opened, even though it gapped up, like my contract went to zero almost immediately because of that implied volatility crush. I was just too far out of the money to where implied volatility just zapped all of my premium, and I couldn't understand why it happened. So I just went on a quest to try to figure out, why did this thing happen to me? So yeah, implied volatility is going to be the most important indicator
that you can use, whether you're trading or investing. Because of course, with investing, you don't want to buy at the highest possible price either. Give that implied volatility some time to come down, so that you can get a better price for, whether it be the stock or the option.
Yeah, definitely. Yeah, and that's something I also agree. One of the things I teach is I teach about the only two Greeks I really look at is IV and theta,
Mm-hmm.
because to me IV is driving the rest of the Greeks,
Mm-hmm.
and then theta is the only one that's not going to change because it's an expiration date.
Right.
And that's what I try to do. If people can really understand implied volatility, and also understand is that you're being sold implied volatility, and your job is to sell that to somebody else.
Mm-hmm.
And I think a lot of people, once they can really kind of wrap their head around that, they kind of understand is that if you're buying a high IV, it can be difficult to sell a higher IV to somebody else. But
Yeah.
what you want to do is buy an IV and then sell a higher IV to your the other person that wants the contract for whatever reason they want it. But the reason why the contracts appreciate a lot of times is because the IV starts to spike up after you buy it.
Yep.
But I think a lot of people, because it's kind of like a fluid situation, they may not be able to understand it from a practical standpoint, and they may be looking for like a number to tell them what the answer is. But because it's so fluid, sometimes you don't understand it until you actually get into the process of it.
Right. Right.
Yeah.
And hopefully it helps to know to just separate VIX from implied volatility when it comes to other tickers. So just because VIX is at 23 doesn't mean that every ticker that I pull up, the implied volatility is going to be 23%. That's completely false. That just means that SPX and SPY's implied volatility is going to be around 23%.
Okay, and that's a good, because the one thing is I like to look for is, and I say this, is that even if the market is bullish, you can always find a company that's bearish.
Yep.
Right, or vice versa. Mm-hmm. And so you're right, is that sometimes the VIX volatility can be one thing, but an individualized company, their volatility could be something different. Just because, like, you can get a pharmaceutical company and maybe their drugs didn't go through, and then so it just starts to crash. So then the IV starts to spike on the put contracts, but the overall market can be very stable and very bullish in the opposite direction. So I think that's really important for people to try to understand.
Right. Right.
Yes, ma'am.
Okay. I'm gonna bring up VIX in my trading view, because my VIX chart on Thinkorswim is messy, really messy.
Okay.
Because I've been marking it up for years at this point. So I'm going to share that one.
Okay.
What we have here? Okay, so you can see trading view.
Yeah, I got it.
Okay. All right. So right now, VIX, this is a monthly chart of VIX.
Okay.
So something that I noticed a while ago that is kind of not VIX as usual, because if you look at VIX like over a long period of time, you see that VIX kind of trades in like a bowl type pattern, where it spends most of its time at the bottom of the bowl, and then it just has spikes on either side.
Okay.
But here lately, on this monthly chart, VIX has been trading in a bullish channel. So it's pretty much been staying between these two lines, two blue lines on the monthly chart. So you could use that as well to assist you in, not only market sentiment, but, saying, hey, I'm going to play the range when it comes to my swings, whether I'm going to catch some puts when VIX is down here at this lower trend line. And then, maybe I'm going to catch some calls when VIX hits this upper trend line. So it's got a few times where it's come outside of the upside of this blue trend line. But for the most part, it's just staying between these two lines. So that's what, current sentiment is on VIX. And so for me, until I see otherwise, sentiment is relatively unchanged. So while VIX could be dropping down toward this lower trend line, the overall angle on VIX is bullish.
Okay.
And it has been since early mid 2021. So for quite some time, it's been creating this channel. So again, like I said, something that I look for is, hey, where is VIX trading in relation to these trend lines on this this monthly chart? So if you are I know a lot of people, at least, people that I know of, they're not necessarily thinking about hedges and stuff like that. So, I'm of the opinion that there are many different ways to hedge, but you can use VIX to assist you in that, in the sense that, let's say my portfolio is mainly big tech,
Okay.
and VIX is spiking. So what I could look for is I could just trade VIX and hedge my portfolio, or I could look to, something that tends to go up when big tech goes down. You know what I'm saying?
Yeah.
The name of the game really is just managing your risk, and really treating your options portfolio like it's a stock portfolio. You know what I'm saying? So looking at your delta to see what your bias is on your overall portfolio, and then making a decision to say, I'm gonna take, maybe I'm a hedge against maybe 10% of my portfolio.
Okay.
And you're not in a situation where you're trying to not lose money. You're just trying to reduce the risk, and that's it. So, that 10% might not even, it'll stop some of the bleeding if your portfolio is heavy in big tech right now. So VIX is a great one to use to hedge, and you can just kind of play the range.
Okay, so let me ask you. So for the people watching that may not really understand the VIX. So do we say the VIX is bullish? How are we perceiving that in relationship to the overall market?
So in general, if the VIX is bullish, then the markets are bearish. And
Okay.
I mean, the broader markets are going to be bearish. Doesn't mean that every single ticker is going to be bearish, because you also have to consider other economic factors like, business cycles and things like that. But overall, or in general, if VIX is bullish, then the markets are going to be trading in the opposite direction.
Okay. Okay. And what you're kind of talking about is similar to what a lot of big funds do, is that where uh, they'll a lot of times go really deep in a particular sector, and then they'll offset that, like you said, with maybe the VIX, or they'll sometimes go really deep into a company, and then they'll offset that by shorting like an ETF that represents that overall sector, just in case everything starts to reverse on them. So
Right.
what you're talking about is really intelligent, because it makes sure that you're not overexposed in one area, because that's what a lot of people experience. What they've been experiencing this since 2022, where
Yeah.
they were very heavily exposed. I put this on my Twitter page that if you just bought tech, you're getting killed right now.
Yep.
Especially if you didn't buy the big names, which is what I try to encourage people to buy. But people like to stock pick, so they went to a lot of more of the speculative plays, and so they're getting really damaged. Because I don't understand how anybody's made money off calls since 2022. But I'm not in calls, so I don't know. But I don't know how anybody's made money off calls. So what you're talking about is really valuable, because it can offset a lot of the risk of just being overexposed in one area. Because the reason why a lot of people get forced out of this market is because they get too much exposure and they're too consolidated. And then when it goes against them, they just get wiped out.
Right, exactly. And that's we've seen or witnessed a lot of people flood the markets after COVID happened.
Yeah.
And at that time, the markets were, running full steam ahead, it appeared. But for those of us that really, study the markets and pay attention, and we've been in it for, a little while, we saw that, there was some irrational exuberance happening.
Yeah.
And for that's the reason most of my portfolio is in healthcare. Okay. So I started, buying healthcare like 5 years ago, when it was kind of underperforming, because I was like, we've been at that point, it was like, this has been like one of the longest expansion phases of the market cycle. Yeah. So at some point, the tables are going to turn, and I don't want to be getting caught up in being heavy in big tech and then be losing on my portfolio while I'm watching all this other stuff, kind of take off. So my portfolio is doing pretty well because I just kind of had that insight to look at those macroeconomic factors and say, what's the best decision for me to make? Am I looking to make a quick buck, or am I trying to build wealth? So I decided to concentrate the majority of my portfolio in those value stocks that I know perform well in a recession. And so that's another thing that even if you're a trader, that you should think about, in my opinion, on a regular basis, is think about those macroeconomic things that impact the entire market, and make your decisions that way, because that's how the money flows, really.
Yeah, and you're 100% correct, because I think, and you talked about it, a lot of people kind of got into these markets as a result of the pandemic. The markets got really hot, and they may not have been aware of how long we have been on a bullish trend and what was the reason for it. I did a video on a lot of that federal monetary policy starting after 08. And also getting boosted back in around 2018. They tried to cut it off, the market tank, they brought it back. And so because they really may not be aware of it, they don't understand that we have been on a really, really extended bullish run.
Yep.
And it was nothing but a matter of time before people started to pull their money out of this market.
Right.
And I just think now people are starting to, and they had hints, because I started seeing it in early 2021 when the rate rose up and everybody just all of a sudden got spooked because they were worried about inflation. So I realized if they're that tentative now, when they change policy, they're going to get really, really scared. And a lot of people just going to take profit. And that's what we've seen, because I didn't realize, I didn't think that the market would be this bearish this long.
Yeah.
Now I'm starting to realize maybe the market can be bearish for a year. But I never would have been. I thought maybe we get maybe a month, maybe maybe 90 days. We're going into month 6, and it's still selling off. It started selling off in November. So I think that's what you're talking about is really important. Is that and one of the things I wanted to bring Lance on is because she can give you show you how to take a longer view of the market, because a lot of times we look at the snapshot of how long we've been in it, but that's not really how long this market has been performing. And you want to kind of understand what are some of the longer term trends that can impact your portfolio and also impact your trades.
Exactly. And so pretty much when it comes to the way that I approach the market is, for the most part, I have a small group of stocks that I watch. And those are, ones that I tend to, day trade whenever I am day trading or swing trading or whatever. But what I do is I try to keep abreast of not only the short term, happenings, but even when I'm day trading, I still have that long term perspective in mind, because I know that when news drops, it's going to happen, at the minute. It's going to be something intraday or something when the markets are closed. And a lot of times I'm looking for news to kind of validate what I'm already seeing in the price action. So that's another thing that I always stress is keep an eye on those monthly charts, those weekly charts, because those charts will forecast what's possible. And I'll show you guys a perfect example with SPX. Let me bring up SPX right quick.
Okay.
All right, so I'm going to pull up the monthly chart, and I'm going to show you guys two important things. I'm going to go back to 2020, right when COVID struck, which is right up in here, right? So in looking at this chart, you see a nice, decent little bullish trend, right? And then all of a sudden, in the month of January 2020, the SPX printed a reversal pattern.
Okay.
This is a shooting star right there. So when you see a shooting star, this is one of my favorite patterns to trade, is a shooting star, especially after a series of green candles, and then you see that shooting star. It's I won't say it's 100% gonna reverse the other way, but 9 times out of 10, that next candle is gonna be bearish when you see that shooting star. And at this time, I don't necessarily know that, hey, COVID is happening, because we had no idea. But somebody knew something. And it's likely, you know, those insiders, those big money people, they started to, you know, get a little spooked right here in January.
Yep.
And so with me seeing this, I'm like, okay, I have to be open to the possibility of February being bearish.
Mm-hmm.
And what happened is they pushed the market up one good last time to another all-time high, and it trapped a lot of people, and they just sold it off hard for 2 months.
Yep.
But I say that to say that the chart will forecast things before it happens. So when I see certain things in the chart, I don't necessarily know why, but I know to be on the lookout for something in the news, some sort of, you know, significant catalyst that could confirm what I'm seeing in the price action. And another thing, and I was telling a guy on Twitter months back, I said, yo, when he was kind of, you know, querying his audience about, you know, what they think was coming ahead. And at this point, the markets were still running. And I said, hey, if you look at the long-term chart, SPX has a big rising wedge right now.
Okay.
And with the rising wedge, the bias on this pattern is bearish. However, it can be bullish sometimes, but for me, I just, you know, going back to those, not just the macroeconomic stuff, but just the technical sense, the markets have been running hard since COVID.
Yeah.
And honestly, when COVID happened, the thing that kind of surprised me the most was that V-shaped recovery, how quickly the markets just rebounded and just went on a tear after that. I was thinking, hey, the markets are going to just go bearish for a little while after this. And it was literally like 2 months and it was over. So this what's happening now, in my opinion, is long overdue, even from a technical perspective, because no price can maintain this trajectory for a long period of time. At some point, it's got to cool off. It's got to, you know, sell off. It could just cool off by kind of consolidating, which, you know, SPX did for a little while, and then finally, in April, that range kind of gave way, and so that's what we're seeing now, where from a technical perspective, SPX is transitioning into a bearish phase of what's called the market cycle. So the whole time, like all of 2020, all of 2021, I was just like, yo, I might day trade a little bit, but something is coming. Something's going to be happening that's going to probably cause a breakdown of this price structure right here. And, you know, recession news and stuff like that wasn't, you know, far-fetched, because we know that the markets have been in that late stage of the business cycle for a good while now. So just following those macroeconomic factors can help you put the pieces together on what you're seeing with the price action.
Okay, and here's a question from $1 Billion Smile. He says, is the shooting star the long red bar?
The shooting star is, let me try to make it larger,
because I know which one it is, but I think he may want to try to identify it.
Oh, jeez. Thing is tripping. Hold on. Don't want to move over for me. All right, whatever. So this, I'm going to put a square around it, actually. Okay. This is the shooting star right there.
Okay. And so when I'm looking at that shooting star, is the market telling me that there's indecision or there's hesitation?
Yep, there's some indecision, because you got nothing but straight buying for 4 months. Well, really more than 4 months leading into that. And then all of a sudden, the bulls aren't sure anymore.
Yeah.
So they start to kind of sell off a little bit, but, you know, not, well, I would say kind of a whole lot, but not necessarily changing the narrative yet.
Yeah.
But just kind of giving technical traders a sign that, hey, something is afoot here in the markets. So just be on the lookout.
Yeah. And that's interesting, because I remember I was getting news of the pandemic because I told somebody that I know that takes the train to go into the city.
Mm-hmm.
And I said, make sure that you watch out, because I said these type of things, because it's a communicable disease, they spread in like places of mass transit, things of that nature. So I was aware of it. And I remember getting information of it being in China. But what happened is Kobe passed away. I kind of got distracted. And then by the time we got into February, that's when everything started kind of unraveling. But I knew about it. And that's when it kind of cemented into me, is that I got to really pay attention to what's going on.
Yeah.
Because me losing focus on the market, I was able to catch some of that sell-off, but not as much as I could have, because I knew, because it was a communicable disease, pretty much any place where people congregate was going to be airlines, cruise lines, places like that was going to be a really good opportunity for put plays.
Yep.
And I remember a guy who had a hedge fund. He interviewed, this was last year, and he said that they had people on the ground in China, and they would get information about really how bad it was. So then they started pulling out of the market, and they started shorting the SPY.
Right.
But it's because they had that on the ground information. And like you said, is that they drove it up. They're going to trap people in it because they think the market is going up, while they're exiting and taking positions. And then they just slam it right on down. Yeah.
Yep. And that's just another good example of how you are able to follow the money based on things that are happening from a technical, or not a technical, but from a fundamental perspective. And that's how I approach news also, is this like a knee-jerk reaction type headline thing, or is this something that's going to have a real material impact on the markets? And COVID is one of those things. Another example, I was day trading SPX, and I was looking at, probably a 15-minute chart, and I saw something was shifting with the price action. And I said, I'm gonna just go ahead and buy some puts on this right quick. And it's like, as soon as I got in puts, it just started tanking. And so I was, trying to figure out what was going on, because when you watch price action, when the price reacts a certain way when there's a catalyst at that very moment that's significant. And so that happened to be the day that they were storming the Capitol. So again, I go back to my question of, is this something that's just a knee-jerk reaction thing, or is this going to have a material impact on the markets? No, this does not have a material impact on the market. So therefore, I need to be looking to get out. This ain't nothing that I need to be trying to milk all day or nothing like that. Just in and out, because it's just, people reacting to a situation that's not really that serious.
Yeah, definitely. And I think it takes some time to get that discernment, because I think a lot of people, what they think is a catalyst, it often may not be a catalyst.
Right.
But and they're always looking for a catalyst to justify movement, but they may have a hard time trying to figure out what the catalyst actually is. And sometimes that can just take time in the market to kind of understand what do we think is going to move this market.
Yeah. And what I did was, in Thinkorswim, they have a live news feed.
Okay.
And it looks like this, and it literally spits out headlines almost every second.
Okay.
So I've kind of trained my eye to look for certain things. Of course, I don't catch every single thing, but I've trained my eye to look for headlines that may or may not be significant. So, of course, I'm not, looking through every single headline during the day, because it literally spits out headlines every single second almost.
Yeah.
But when you catch something, then you have that news right there at the moment, and you can really make that decision at the moment to whether it's something that, you need to take advantage of, or something that's not really that serious. But again, that took me a while to be able to develop that skill. Just really sitting and watching headlines and trying to, in noticing patterns in what's significant and what's not significant. So just a little tip, for you guys, especially if you use Thinkorswim. The live news feed is probably one of my favorite features of it, because I can kind of get distracted if there's like news going on in the background, like somebody's talking.
Yeah. And
I just rather read a headline, and if it's something that I'm interested in, then I can click on it and I can read about, whatever it is. But a lot of time, what I've noticed is the markets react to headlines.
Yeah.
and you might open up the actual headline and read the news, and it's just not that important. But somebody saw the headline and got spooked. So
yeah, you see that a lot of because we got so much algo trading now. I think they're programmed to trigger off certain words and things of that nature. And we saw that with Jerome Powell when he was like, well, a 0.75 raise is not on the table. And then we saw a lot of buying behavior.
Right.
And then it ran up really hard, but we saw it hit resistance and it wouldn't go past that. And then the very next day it gapped down. So we see a lot of that. I mean, a lot of that, especially when Trump was in office, we're seeing a lot of that off his tweets.
Right.
So I think that's going to be something that we're going to have to experience even more of, because it's going to be a lot easier in the future to create those algorithms. People trying to figure out how to get that edge off of what somebody says or news and things of that nature. And it's just something that we're going to have to start trading with. I get a lot of my stuff off Twitter, but I'm more of a swing or elite trader. So the daily news, sometimes it can happen. It's not as significant, but sometimes it can. Because like I had puts on Avis, and I found out they were going to do like $1 billion buyback, and those puts was pretty much over once that news came out. Yeah.
Yep. So with your mentioning the interest rate stuff, I think that at this point it's possible that the markets have already priced in those 50 basis points hikes.
Okay.
Just looking at SPX, for example, from a technical perspective, 3860 is the bear market, pretty much line in the sand. Below 3860, then SPX is below 20% pullback.
Yes.
The fact that bears did not successfully close it out below 3860 was significant. And just from the fundamentals of technical analysis, that kind of gave me some insight into market sentiment. So, with that, I was saying, a couple days ago that, hey, it's likely that we see a rally because bears missed their chance to pull this thing into a bear market. So, while big tech's been in the bear market for a while, deep in correction territory and stuff like that, the broader market, that being SPX and things like that, they're just, deep in correction territory. So, like I said, SPX or the bears failed to close it out below 3860. So just from a technical perspective, the markets try to rally and the bulls try to, want to try to get this thing back up. Maybe the levels that I'm watching to the upside on this rally, I'm thinking it may be a rally for people to get a little exuberant again and think, oh, the worst is over now. But I think it's likely going to be a trap. But I think that they're going to pump this thing maybe to, I would say no more than 4,400, and I'm just giving it a little wiggle room. But some major levels that I'm watching to the upside is 40.95, about 41.60, so mid 41 area, and then about 42, and then 43, and 43. I think about 43.33 is the correction territory. So that minus 10 on SPX. So matter of fact, I'm gonna show you guys what I'm talking about.
Okay.
All right, I'll take all my studies off because they don't matter. And forgive me, y'all, for all my lines. I've been marking charts for years. So let's take a look at the monthly chart first. So from the monthly chart, just like I said, just during the month of April, did the markets finally close outside of this range that it's been trading in really since May of last year. So since May of last year, SPX had been trading in a range from about 41.40 up to that all-time high area. And then just recently, last month, it finally broke that level to the downside. So what typically happens is when major levels are broken, the price comes back and retests that level, and it either confirms it, which would be the price will reject that level, which would, basically confirm the breakdown, and the price would continue another leg down, or bulls are able to push it back over that level. So in my knowing this as a possibility, then I know to look out or listen out for certain things in the news. So what I'm thinking about is, and it's a question that I like to ask you, Dave, because I've been kind of going back and forth with myself about it, is if JP comes out and says we're gonna put 75 basis points on the table, does it shock the markets, or does the market say, okay, you're finally being aggressive enough and we're happy about that?
Yeah, and I think if he comes out and he says we're gonna do 75, I think it shocks the markets, because in my perception of this is that the market wants cheap capital, and if they can't get cheap capital, they just sell the market off. Because the only reason we went on this bullish run after the pandemic is because they essentially said, we'll damn near almost pay you to take money. And so I think the market have gotten so addicted, and even before that, because in 2018, when they tried to raise the rate, they sold the market off again.
Yep.
I think the market is so addicted, and the banks are so addicted to pretty much being able to get money from the Fed at almost 0%, that they can go outlay that into the market, get a return. It's just an easy way for them to make money, because if me and you can get money at 0%, we can make money anywhere because we know where to put the money.
Right.
I think they're addicted to that relationship. So I do think they even though they have priced into 0.5, I don't necessarily believe that all the bearish activity is out of the market yet. I think they're still working on trying to exit their positions. They're just going to do it gradually as opposed to a massive sell-off. But I think at 0.75, it would be a massive sell-off, because 0.75 could lead to another 0.75. So if he opens up the door to the 0.75, I think they really get spooked and realize it'll probably be better to get out of the market now than wait. And then I'm in these companies that are going to be impacted by the higher cost of capital. And then therefore, I need to get out now as opposed to maybe thinking I can get out later. So what we kind of saw was more of a gradual sell-off. I think if he comes out and says we're going to do 0.75, I think we'll see a massive dump. We'll probably wake up and, the thing will be down, and it gap down a lot of levels similar to what we did during the pandemic. And then every consecutive day, it'll probably keep selling off. But their hope would be that he reverses it. What I think they're going to try to do is maybe we can get this market to a point where he says, okay, the economy's cooled down. I don't have to have the same monetary policy. Because the reason why he's enacting the monetary policy is because the economy got so hot, because the market started running so fast. We had a lot of supply shocks, which raised the inflation. What I'm upset about, I wouldn't say I'm upset, but what is curious is that, from my understanding and the way they train us as an economist, is that the Federal Reserve is not supposed to be worried about the stock market.
Right.
But we see an environment now to where Federal Reserve monetary policy is being dictated to by where the market goes. I didn't think that was his mandate, but that's what we're dealing with now. So this is where we got to go. But I'm not and I don't know if we want to roll into this yet, but I'm not 100% convinced that we've hit a floor. I think that because I don't see the volume there. So until I start seeing the volume, which to me is going to indicate demand at a higher price, I'm not 100% convinced we see a floor, but it doesn't mean it won't happen on Monday or Tuesday. What I think is caused today, and maybe a little bit of a slowdown in selling, is we're getting ready to go into monthly Operation X. They don't want to pay all these puts out. So they're going to just pretty much chop the market up next week. And then maybe after this week is over and we kind of start late in May, we might resume our selling. Yes, ma'am.
I definitely agree with that perspective, that the 75 basis points will shock the markets.
Yeah.
And even looking at it from a technical perspective, the bulls haven't had a chance on this longer time frame to defend this area yet. Bears pretty much just came in and took over these last, several weeks.
Yeah.
So just because, we get a rally up to, 4,300, for example, that doesn't change the narrative on this longer term chart. So another thing that's important, for traders and investors is to be able to put multiple time frames together to form an overall opinion. So for example, the markets could chop all around all day, but still be, kind of another way on a different time frame.
Yeah.
And when you look at these higher time frames, so the monthly, the weekly, and things like that, those are your more important time frames for your overall context as to what the markets are thinking about whatever ticker that you're looking at. And so technically from about probably April of last year to probably about April of this year, the markets on the higher time frame were just kind of ranging. So lots of indecision, not quite, we're going bearish on this thing, but just a cycle transition. So you got a strong bullish phase here, and then it just transitions into that sideways movement, and then phase 4 is typically bearish. So that's why I'm saying I'm waiting to see if in the coming months or so, bulls try to push this thing up, toward that correction level, or even, maybe they don't even get it that far. So that's why I gave those other price levels of about 40.95, 41, mid 41s, so on and so forth, as levels to watch on the higher time frames. So don't get caught up in the day to day being like, oh, this is more relevant on the monthly chart, because it's not necessarily.
I'm sorry, go ahead. I didn't mean to cut you off.
No, go ahead.
Yeah, and so I want to speak to everybody that's watching, because I learned from this guy that makes a lot of money trading Bitcoin. He talked to me about setting on my display. He said, take the red and the green off because they're like psychological stop goals.
I've heard that too.
Yeah. So I think because of the way we've been trained, especially think about money, we have this aversion to a down market. And one of the things where I want to link you to people like Lance, and one of the reasons which I teach what I teach is because I want to get people to kind of get deprogrammed to thinking that if the market is selling off, it's negative. You can make money in any market.
Exactly.
I just don't want the market to go sideways. I want it to have a direction.
Exactly.
The media knows that there's an aversion because people's 401ks are tied into this market. Their retirement's tied into it. That when the market starts selling off, they start getting very anxious. So they will create media about the market turning around.
Yep.
It doesn't mean it's going to turn around because big capital may have decided they're not done selling this market off yet because they're pulling their money out of the market. So I want to really help people understand that if once you really learn how to manage the market and how to trade properly, it's something that Lance talked about, the hedging, even though you may have a long equity position in the market and the market starts to turn red, it's not a reason to become anxious because you know how to monetize that. But if you are caught into kind of like this media narrative that anytime the market is selling off, it's a negative, then you have to start believing, okay, well, maybe we're getting ready to turn around, and maybe we're getting ready to turn around. It's going to turn around when it turns around. But until it does turn around, there's opportunity for you to get money out of the market if you kind of understand how to navigate it. Just want to say that real quick.
Right. And I want to add on to what you were saying about, what were you saying? Jeez, I forget. I lost my train of thought. It's all good. But yeah, going back to knowing those, paying attention to those macro and microeconomic factors. If the market is selling off, that doesn't mean that every single ticker is going to be bearish. Yeah. If you are, like Dave was saying, a lot of us have aversions to the market going down. So naturally, we don't want to get in puts. So you can find things that have relative strength against the market that you can hedge with a bullish position. Yeah. Take a look at, do a study on energy for the last decade or so. Energy was down big while everybody else was having a good time. So coming into, this year, at some point that money's going to flow back into energy. Yeah. So if money is pulling out of one area, it's going somewhere. Definitely. It can even go to cash, but a lot of times they're going to go to a different area of the market where they're going to be, maybe going from growth to value or back to growth from value. So if you don't like to play puts, you don't necessarily have to, but it's definitely important to know how to follow the money. And that's one of the significant things about knowing how to interpret news and indicators, and just knowing those cycles, those natural cycles in the markets.
Yeah, definitely. I'm glad you talked about that, and I think that's really important. And there may be, and I'm not I don't know any of them, but you got those inverse ETFs
Yep.
where if the market goes down, they go up, then you just can get calls on those.
Yep.
There's a million ways to play this market, because I learned from you, Camp, Mecca. It's all kind of little ETFs I had never heard of. Like I didn't know about the UV until like a year ago. Yeah, so there's a lot of different ETFs and things that you can play that can allow you, if you don't like playing puts, to stay in calls that can just go opposite of the market if the market is selling off. You just got to find out what they are.
Yep. And going back to, you're saying you don't think the markets have bottomed. I don't think the markets have bottomed either. I feel like, like I was saying, I think the markets are going to rally a little bit, just like a little relief rally. Probably just enough to get people, interested again and being like, oh, the worst is over. And then they're going to drop that thing again. But I think that it's a possibility that the markets go back to pre-COVID levels. And when I say the markets, I mean SPX, because a lot of equities have already hit pre-COVID levels and fallen below them, but SPX hasn't hit that yet. Okay. And you can see that on my chart. Pre-COVID is just below 3,400. So we're just over 4,000 right now. So like I said, I think we bounce from here, and then we're going to head somewhere in this area, and then maybe come down again, or just consolidate, because that's a possibility as well. But I'm thinking that one of the scenarios that I'm kind of playing with in my head is a scenario where JP is going to have to get more aggressive. And me and Russell have talked about this, with him having to get more aggressive to combat inflation. And lately I've been seeing headlines where he's talking about he's kind of moving away from that soft landing farce. And he's talking about, they're just be expecting some pain. Like we've already seen the pain, feeling the pain at the point of sale for a long time now. Yeah. So I think, I'm just kind of listening out for like some sort of official piece of news to where monetary policy gets more aggressive. Maybe they say, we're going to completely stop buying bonds. And, so, that kind of thing. So just, I let the price action kind of let me know whether to be expecting some sort of, catalyst if the price action is saying that. So that's kind of how I use them hand in hand. And then I also use the fundamentals to let me know if whatever piece of news I'm looking at has a material impact on the markets, or if it just has a material impact on that company that I'm looking at. And that kind of dictates my psychology about that particular position.
Yeah, definitely. And I think because I know we're going to do another CPI number, I believe, next month. I think it's going to come in lower than this one. But I'm looking for what are they going to try to use as a catalyst to go to maybe a 0.75 raise. Because they pretty much said we're going to do multiple 0.50 raises. I think they said they want to end the year at around 2.5%. So if we go to 0.75, then the question is kind of like, what are we going to use as a justification to do it? Maybe they're going to just come out and just say, well, maybe we actually are in a recession. I don't know what it's going to be now. So that's the biggest thing. But then we got the midterms coming up, and then does the administration want that kind of policy while we're going into the midterms? That can get complicated. So I'm just kind of watching to see what do I think is going to be the catalyst to make him come out and change it. And then will it be something that they're going to do through a formal meeting? Because I think they got another meeting in June. Or is it just going to be something that they're going to just spring on us? And then, as a result, the market's just going to go into a frenzy.
Yeah. I think I'm kind of toying with the idea that maybe GDP is going to be one of those catalysts, possibly.
Okay.
I think they want the GDP to be somewhere. I just looked at the numbers the other day. I think they're shooting for like a 2.5 to 3.5 target or something like that.
Okay.
And I feel like GDP is going to come in lower than that at some point.
Okay.
And then they're going to have, at that point, they're going to have to say, you know, we're going to have to get more aggressive so that we can increase or improve our GDP numbers. Because if you look at the trend on GDP, what's happening is government is spending less, businesses are investing less, but consumers are spending more. And in this environment, that's not sustainable to have so much of your economy depend on consumer spending, but you're in a situation where prices are inflated, supply chain issues and things like that. It's a recipe for disaster.
Okay.
So it's just a hunch, a hypothesis that, you know, maybe it's going to have something to do with GDP.
Yeah, I mean, I 100% agree with you. I mean, it's going to have to be something, and it's going to be interesting if they do raise it, kind of how they roll it out, because you're right. And so this is what I'm looking at, and like I said, this is not investment advice. A lot of the companies are, like you said, they're at their what we would call the pre-COVID levels. But what I'm looking at is the companies that I know are managed very badly. They have bad balance sheets because I think they fall under that.
Yep.
And so I'm looking at companies that I know they don't have the ability to function in the future just kind of based on how they're composed. And one thing I know about a bear market is that a bull market is money will leave bad companies quicker because there's better opportunities out there for it.
Yeah.
So I think that's what we're going to find. What we kind of saw in the pandemic was a really weird scenario to where people was putting money into anything just because money was so cheap. I think now as the cost of capital starts to go up, people are going to be a lot more selective about where they actually put their money. And so any company that is not really performing really well is prospects. So let me give you an example. A firm saying they're not going to be profitable at earliest to 2023. And they're spending more money. They're spending more money to make the money they're making, which means in reality, they're making less money. So as we go quarter after quarter, if that spend keeps going up, in reality, they're making less money, which means that they're going to push their profitability projections out into the future. I don't really see a long-term future for that company just based on that. Right. So those are the kind of companies that I'm looking at the way in which they're structured is probably not going to work long-term. And that is just based on that particular element. We're not just talking about the fact that the consumer can just be like, I don't have any more money to spend, so I can't do business with a firm anyway. Yes, ma'am.
Yep. I agree for sure. And you know, if you're a technical trader, you're just learning charts. All you got to do is pay attention to those long-term charts. You don't have to watch them, you know, on a day-to-day basis because that's just noise in the grand scheme of things. What you need to be looking at is those major price levels and what's happening with these with the price action at those levels. Like, you know, here on SPX's weekly chart, we got a hammer that occurred right at a significant level, which is that bear market territory level. Also, it is near that level where you mentioned that 2018 when they tried to raise rates.
Yeah,
that's also where near where SPX tested this week, and it bounced there. So I'm not necessarily looking for a narrative in the markets that would turn things around, because I think that the current narrative is just too strong right now. But like I said, I think it's just going to be, you know, some relief. Bear's been going hard for several weeks at this point, and you can't just go down forever. And the markets tend to rise for longer than they drop. So, you know, just keep that in mind. The drops are typically swift and short, and the rises are, you know, a little more sustained. But let's say, for example, the markets have bottomed. What kind of narrative do you think comes in the markets to turn this around?
The narrative is that we hit the bottom. So and that's kind of what they're trying to say now. Like they were saying the other day was like, well, you know, if Apple sells off, it means we're at the bottom. That I told somebody that doesn't mean we're at the bottom. It means we're at the bottom when people decide that demand is going to be greater than supply.
Right.
That's how we're at the bottom. So it got nothing to do with Apple computers. It has to do with buyers saying, we want to buy this at a higher price, and the price keeps moving up in relationship to the supply that they can buy.
Mm-hmm.
So, but they'll try to create a narrative because what they want to do is get retail comfortable putting their money back into this market.
Yep.
So I think that's what it is that when the big funds and the big investment banks decide that, you know what, really what we've done is we've taken enough profit. We've made enough money on the top side. We've shorted this down and made enough money. So now we're willing to ride this back up. So now we create a narrative to get people a little bit more comfortable coming back into this market.
Mm-hmm.
Because they know based on what happened in 2008, a lot of people got so scared because the market sold off so bad there, to where when they see the market selling, they kind of realize that they're not in control. They're just kind of along for the ride, and it can scare them out of the market permanently. So I think that's what they're going to just start creating a lot of media pieces about. We're at the bottom, and here's the places that you can go to get X amount of return over the next 12 to 24 months.
Yeah. And I think that's an excellent point. That's kind of like a great segue into talking about the importance of charting data.
Okay.
Because when you're able to chart data, you can see the trends and the lies are exposed. So let's say it's Thursday and jobless numbers come out and they're greater than expected. What does that mean in the grand scheme of things? Nothing until you get a chart of jobless claims over, a year, over 2 years, and then you can see, oh, the trend is actually not that great. And so then the lie that's being fed to you in the media is exposed. And you said something that was really, really important in your video that you did recently, where you said, be the analyst. And that's a part of being the analyst, is do your own due diligence. And you'll find that you'll start, realizing information that may not be true, based on what they're saying in the markets. So, or in the media. So the media may say, oh, the economy is so strong and blah, blah, blah. But then you look at the trend, on the GDP components, and you see that business investment is actually decreasing. Government spending is decreasing. Consumers are spending more, only because, not because their buying power is increased, but because prices are higher. So that does not paint the picture of a strong economy. So then you know how to spot the lies in the media, and then you can trade accordingly, because that's what the institutions are doing.
Yeah.
Retail is a lot of retailers are just taking the news at face value and trading based on that. But what you don't know is that the institutions may be quietly selling, because they know, they've looked at the trend, they've looked at the data, and they say, oh, this economy is just not, it's just not what we're not even paying attention to, what they're saying on CNBC. We're paying attention to what we're seeing in the raw data, and the raw data says this is not good. Now that's not what I'm saying or anything like that, but just an example, that a little nugget that I hope you guys can carry with you, to chart the data, and even with the whole fundamental versus technical stuff, what people don't know is there is a big numbers component to fundamental data. And if you don't chart those numbers, then you don't know what the trend is over time. So that's why charts and fundamentals just really go together. There's really no, verses in any of that. So if you got people telling you that, don't just ignore that, really. And you get people that try to sway your opinion one way or the other. I say be sharp in both. Because again, like I said, when you start looking at those numbers, with the economic data and things like that, those indicators, then you're able to see what the trend is. And you can't see a trend without a chart.
Exactly. And I 100% agree with you. And I think people realizing that, like CNBC, they're good shows. They do what they do, but they're really designed for retail. The funds have their own people that analyze. They do what we do right now. They sit around and talk about this stuff. They break this stuff down. They bring people in like Lance and say, okay, what do you think about this? she gives them her explanation and say, okay, cool. They pay her like $20,000, and they use that information to try to figure out what direction they want to go into. So that's what people have to understand, is that the big funds are not really watching Kramer or any of those people. And it's not that those are bad people. It's their job is to entertain an audience of people who are primarily retail, who don't want to do the research.
Right.
And the problem is that you're listening to an entertainer whose job is to entertain you, so he's not boring, tell you about where the stock market is going. And he may not necessarily be doing the best due diligence. Right. And he's also reading the teleprompter. So that's why I want to really encourage you to start, listening or watching. Lance got a really, really powerful YouTube channel, which he kind of shows you how to break down these tickers and kind of what you want to start looking for, and just start watching it and going through the process. And then you can start looking at your chart. Because to me, when I look at a chart, I'm just looking at data in a visual form. Yep. And that's all I'm seeing. It's just data in a visual form to kind of make me understand, can I find trends or can I find patterns that can kind of make me get a better understanding of where I think the market is going.
Exactly. And that's what people do. They analyze a company, and they analyze the global market, domestic market, all that good stuff. And then they go to the markets and they decide, is this a good price to buy this? Or am I not willing to buy this because based on the fundamental value, it's just not worth it? Or, hey, this is a great, strong company. It's positioned to do well. And the price, the cherry on top is that the price just so happens to be at a great level that I want to buy.
Yeah.
That's it.
Yep.
So if you don't do anything else, chart the data. Don't just look at, the numbers from week to week. Chart that data and look at the trends. And a lot of times you'll find that trend does not correlate to what's being said in the media, because the media, they're like, as David said, their job is to get retail to be comfortable putting their money back in the markets. And so they're going to spin any kind of narrative to make that happen. But the institutions aren't thinking like retailers. They're charting the data. They're doing their due diligence. They're not just, taking media at face value. And they're positioning themselves to win. So we have to train ourselves to behave in the same way if we want to survive in the markets.
Yeah, definitely. I 100% agree with you. There's a we live in an area where we live in an era where there's a lot more information that's ever been available. We just got to kind of learn to start understanding how to compile it and being willing to kind of do the work. And one thing I learned about my analysis is I can now look at a chart and just see support and resistance, which is what I'm looking for anyway.
Yeah.
But it took a long time for me to get to that point. Now I can't see a lot of patterns and stuff, but I can definitely see support and resistance. I can just look at a chart and see the support and resistance level, which is primarily what I start looking for. And so that's what I want. When I looked at the SPY today, and I've been looking at that, now my resistance is around 300, really 303. And what I saw over the past 5 days is it can't get past that level. And so I'm just able to see that where the buyers dropping off or leaving, and where's the buyers coming in at, so I can kind of understand where I see there's weakness in the market and where there's a lack of conviction in the market. And that's the reason why I said I'm not 100% convinced that we're out of this phase yet.
Right. Is
because over the past 5 days, we can't get that SPY or the NASDAQ over this particular number. It keeps hitting it and it's selling down. It keeps hitting it. So nobody really believes yet it's time to drive this market up for whatever reason. And we'll know when they drive it up.
Right.
So that's the thing, is I'm trying to figure out, when is the market going to say, okay, this price is so inexpensive, I'm willing to buy it at a higher price. And then we get, more demand following them into that particular store, into that market. And that's all I'm looking for. And that's why I want to really encourage people to start going through that process, because it's difficult until you do it. But then once you do it over and over again, it becomes a lot less difficult.
Right. Okay. Thank you, each, since they were asking what my YouTube channel was.
Okay.
I agree, wholeheartedly. And a lot of this game is just patience. Most of your time you're going to be spending, even if you're more of a technical trader, most of your time you're going to be spending analyzing charts and finding something that you like, whether it be a certain setup or whatever, with the price action that you're seeing that you like, whether it be, a upside move or a downside move. And I'm pretty sure it's the same way with you, where you spend a lot of time doing your due diligence, and then you make the decision, based on your criteria. Hey, does this fit my plan? And, I'm going to govern myself accordingly. And then you spend a few minutes positioning, and that's it. And you just wait for it to play out. And a lot of us, we rather do it the opposite way, where we want to spend our time trading instead of spending most of your time preparing for the trade, because the actual trade is just clicking a few buttons. But if you go away with nothing else from this, just definitely learn to combine both elements, because in my opinion, they're just two sides of the same coin. One involves looking at price action on a picture, and the other involves, reading words and reading data, whether it be economic data or whatever. But either way, you're looking at, the same data.
Yeah.
So
yeah,
it's just
100%.
different ways of looking at it.
Yeah, because I have an example is that looking at Carvana, I hope there's a relief rally, so Carvana can drive back up. I really believe Carvana is going to probably be bankrupt in 3 years. So I hope there's a relief rally. They maybe move back up to 100. I have leap puts on that, but then allow me to get into even longer puts going out past 2023, because they just released a PDF today about how they're going to try to reposition their business. I got to read that. So they're going to try to keep this thing going as long as possible. But you're right. And I think a lot of traders don't get this, is a lot of what we do, whether we're technical or fundamental or combination, I think I see myself as a little bit more of a combination, is that a lot of it is spent just researching and doing a lot of analyzing. Mm-hmm. The trading is a very small part of it. And one of the ways in which I become successful at it, and I'm going to maybe do a video on this, is that to me, the analyzing to me is fun. Yeah. The trading to me is really not that fun. It's like whatever. It's like doing data entry work. But the analyzing to me and finding those opportunities in the market, to me, it's become fun to me. So I'll do it just to have something to do, even if I'm not even going to play it. Because to me, I'm sharpening my skill around that particular ability. Yeah.
Yep. And going back to your Carvana example, that's like a perfect, simple strategy for positioning yourself in a trending market. So right now, over the past little while, the markets have been trending downward. So you don't necessarily want to get caught up in the pops on that. Yeah. But the pops represent opportunity to get puts at a cheaper price.
Exactly.
So, and then the same thing when the market is trending up, when the markets dip and they dip to a significant level, that's an opportunity to get calls cheaper.
Exactly.
So, but the mind trick is keeping that perspective versus not getting caught up in thinking, hey, the trend has changed. So I'm going to go ahead and position in calls in a bearish trending market. It's cliche, but the trend really is your friend. Yeah. And I have to tell myself this a lot, because sometimes I still get caught up in trying to trade against the trend. And it can work for sure, but you just really have to keep the right perspective. But if you're swinging, the best way to swing is just to trade with the trend and be patient enough to catch things, when they pop. For example, a couple of weeks ago, I was telling somebody was looking to get in puts, and the markets had already dropped, significantly. I think at this point, SPY hadn't crossed below 400 yet. It was coming down to 414, a little below 410. And I said, no, don't get calls yet, or don't get puts yet. I said, because the bulls haven't had a chance to defend 430 yet. Yeah. So I was like, it's a good chance that the market is going to pop up into 420 and 430 before it drops again. And that's exactly what happened. SPY popped to about 429 and some change, and now we see where it is now. So just having the patience to say, okay, I'm gonna wait and see, if SPY pops up to 420. If it keeps falling and I didn't position, it's okay. There's more opportunity out there. But drawing up that plan and following that plan is what builds that muscle of success, over time. So catching, you know, imagine waiting for SPY to pop to 430 and then going out a couple of weeks and grabbing, you know, maybe some 400 or whatever. If you like to trade right at the money, that's big money.
Yeah.
And you got it at a great price versus getting it at 410 and then having it retrace to 20 points on you. And then you got to wait for it. It's got to go way past your stop, not your stop, your strike at that point for you to make your money back. So just don't make it too hard on yourself.
Yeah, I feel, yeah. I mean, you're giving really good information, because I think a lot of times we get anxious and try to make it, and a lot of that just comes from not being comfortable because you haven't had a track record of success, and that's something I've had to learn. There was a time to where I made a lot of I would trade stuff that I really didn't understand what was going on, but I thought I did, but I really knew I really didn't. And so I was gambling really hard, trying to hope that it works. I made a lot of mistakes like that with Tesla. To this day, I don't trade. I don't know. I don't understand hardly ever where that company's going. And I made a lot of money.
Tesla's a tough trade.
Exactly. I made a lot of money, and I lost a lot of money trading that too. So I just got out of that game. I said, you know what? You're going to always end up net negative for the year trading this company. So I just had to let my ego go, walk away from it, and start picking opportunities where I had a better understanding, because Tesla has such a strong cult behind it. It don't matter what happens, they're gonna buy it up. So it doesn't matter what happens. They'll sell down and then they'll buy it up again. I say, let me just get out of this game, because I can't win with these people. They're gonna always figure out a way to beat me. So that's what I had to do. So once I was able to get a lot more mature and kind of take my ego, because I used to have the mindset of, I want to beat this ticker and I want to put myself in a very complex situation and win. And I had to learn to take easy wins. And the one loss I've had all year was on a hard play. Every play that was easy, like not investment advice, Wayfair, another company that's losing a lot of money. I hope they also run up to a 70, 80 so I can ride them back down. All the easy wins I took, I made a lot of money. But every time I put myself in a hard position, trying to prove something, I lose money, because it's too hard, and you don't have to do that to yourself. But once I'm still working on getting over that type of stuff.
Ego is a big thing in this game, and and I think you said something like this to this point in a recent video that I watched, where you talked about the importance of dropping your ego when it comes to trading. Like you have to, you really have to, and that's a big part. Knowing yourself is a big part. There are tickers that I tend to stay away from. Nvidia is one that I don't mess with, because I like volatile tickers for sure, but I'll never forget it. My last Nvidia trade was a day trade. I had it set up just right, got in it. It moved like 10 points in my direction. I made like $25, and I wasn't super far out of the money. So I was confused as to, why that happened. So I was like, I'm just leaving Nvidia alone. I'm just leaving it alone. Cause it just caused me too much emotional stress to make $25 off of that. So definitely finding the easy plays are definitely, the best way to go. And I tend to get caught up in trying to make wins out of complex plays as well, but missing the easy money over here. I did it twice this week already. Yesterday, I was looking at a few tickers after earnings reports of Rivian, Squarespace, SPY, and Disney. And so I was like, my overall narrative for the day, not necessarily like broad market long-term perspective, but just, I like to, if I'm day trading, I like to know what the narrative is for that day or whatever. So my hypothesis was that the markets were gonna kind of reverse the other way a little bit, just on a day-to-day time frame. And so I got caught up in the red candle, and although I knew going in, I said, okay, if the markets go bullish today, then Rivian is going to be a great play. Squarespace is going to be a great play. but I took the Disney puts and got mauled. Trying to play the more complex play instead of just jumping in the ones that they had the earnings catalyst, and they were trading with the overall sentiment of the market. So it happens, so you just kind of have to, it's not something that you just conquer. It's something that you're constantly, every time you sit down to trade, you're having to face your ego and making the conscious decision of, am I going to go with my ego, or am I going to go with, what my desired result is with this trade or whatever. So
yeah, definitely. Yeah, it's something I had to work on too. So in closing, is there anything that you want to kind of wrap with our audience to kind of let them know before we get up on out of here?
Just pay attention to those long-term charts. Even if you're a day trader, always have that long-term context in mind, because like I said, when that news drop, you don't want to be out of the loop and not knowing what's going on. But if you're looking at, a long-term chart and you're seeing, oh, I'm starting to see some gradual selling in the markets, then on a day-to-day basis, when you sit down, you have that in the back of your head that, hey, I'm sitting down to day trade today, but I know that there's been some gradual selling. Then I know to be watching for something in the news during the market hours, possibly. I mean, it doesn't have to happen during market hours, but if it does, it's likely going to send shockwaves through the markets, and I'll be prepared.
Okay. And if somebody is, let's say somebody's trying to get into like doing technical analysis and they kind of don't know where to start, what is something that you would suggest for like step one of them trying to start?
Step one is just learn what the candles mean.
Okay.
Learn what the bullish candle means. Learn what the bearish candle means. The different types of candles. So you pretty much got bullish, bearish, and then you got your indecision candles. And then move on to candle patterns. And these are your 2 to 4 or maybe 5 candle type patterns. And then eventually work your way up to those more advanced patterns like your bull flags and things like that. But really, if you don't do anything else with a chart, know how to chart the trend and know where the buyers and the sellers are. You don't have to know all that other stuff. You really don't. I know it because I just like it, and I just love charts. So I'm always trying to learn, more advanced stuff. But really, at the end of the day, where's the buying and the selling, and what is the trend right now? That's it.
Okay.
Because a lot of times, what you'll see is in a trending market, the price will pop up or drop down to one of those buying and selling areas, and then it'll either reverse course or it'll continue in the same direction. So that's simple.
Okay. Now I know that you got let me go ahead and put up that you got an offer out right now. Let me go ahead and find that. And I want to give everybody the opportunity to look at that. Link bio, INKey.bio, charts and price action. So give us a kind of basic understanding of what that's about.
Yeah, so that goes into just like the fundamentals of price action, learning how to identify where the buyers are and where the sellers are, because that's all those advanced patterns are, is like a little more of an advanced way to identify support and resistance, but it's the same type of thing. And those patterns also offer you context. So I get into that pretty deeply. And I do also a pretty good bit of it. We do trading psychology, and it's very practical based. So I'm big on data science with charts. So over my years of watching the markets on a day-to-day basis, there are some fundamental guidelines that I just swear by that I share in this class. So what's one? One of them talks about it's a rule based on SPY itself.
Okay.
So if you want to learn how to trade SPX, learn how to trade SPY. So it goes a little more deeper into that. So just little things like that, because for me, a lot of people tend to make trading psychology very abstract, and in this arena that doesn't necessarily work for me. So that's why trading plans are important. That's why you have your rules and things like that, because they're meant to assist you with your trading psychology. So I get deep into that in that course as well. So a lot on some semi-advanced concepts on trading, not trading psychology, but price action, but don't confuse with semi-advanced to, oh, I'm a beginner and I won't understand this, because it's very simplified across the board. So
okay, and I want to encourage everybody to make sure they take a look at that. Lance, she don't do like 6 videos a day like some of these other YouTube guys does, but her videos are very powerful. You just got to catch them. But that's the thing, is that if you go to her channel and really start going into her library, it's a lot of really powerful stuff. And one thing about her is that she's really committed herself to the space, and so she's getting the results. And so you can do the same thing. It doesn't mean that it's not it won't happen faster or slower than what she's done, but it's just a commitment. Because I remember her telling me like, she would spend sometimes 4 or 5 hours just looking at charts. And I think that's how she's gotten so good at it. And so then I was able to accelerate my learning by learning from her, because then I didn't have to necessarily spend the 4 or 5 hours, because she just streamlined it for me. That's one of the reasons why I put in my VIP. But I've learned a lot from her, because to be real with you, when I first started trading, I didn't know anything. I couldn't even find a support or resistance line. Mm-hmm. And so me linking up with people like Lance and getting the understanding from her about how to do this stuff is how I became better as a trader. Because before I do any trade, I need to know what the support and resistance is, because then I know the ability for those prices to get to those particular levels. I had a guy I was talking to today. He was looking at spot, and I said I would be wary of it because it's under its IPO price. So now it's kind of like into an unknown trading range. We don't really have a support level there. So I told him, you would kind of want to be careful of where you may think that thing's going to go, because it's dropped off so much. I don't know how far it's going to go down, because it's kind of like in new water. So me really tapping into people like Lance that were a lot more successful than me when I started coming into this space is how I was able to accelerate my learning, because I just kind of try to figure out how can I learn as much as possible from people like that. So I want to encourage y'all. So I appreciate everybody coming through. I'm going to put her information in the description if anybody has missed it. Put her YouTube, put her link, put her contact info, and then we'll try to get her to come back through at a later date for another video so we can just keep this going.
All right. I appreciate you. Thanks.
No problem.
Thanks for watching, y'all. I appreciate you.